Anand Shah joins us, CIO with Portfolio Management Scheme and AIFs with Prudential ICICI. Anand, good morning. Thank you for joining us. Let's start with the market view, risk versus reward. How would you assess the situation for our viewers?
Hi, very good morning, Nikunj, and good morning to all the viewers. I think, look, the phase of the market has clearly changed, and I'm saying this in a very medium to long term context that we had a very difficult period in the equity markets in general. Money making was not that easy between 2010 to 2020, but at the same time, 2020 to 2024 has been excellent, and this is because the earnings growth was fairly muted between 2010 to 2020, largely led by cyclicals and corporate banks. If you see, the profit to GDP fell from 4.7% for NSE 500, 4.7% as a percent of GDP, to as little as 2.7% in 2019 and 2% in 2020. That sort of bounced back to 4.8%. So very clearly, we had a very strong earnings growth, again led by manufacturing, cyclicals, capital-intensive businesses, and obviously the recoveries in the corporate banks and PSU banks. That has really boosted the profitability, and money making was very easy in those 4 years of period. I think 2025 is first year when we had fairly mixed market where it was difficult to make money. My take is coming few years would be similarly difficult in the sense that you will have to have deep research. You'll have to do stock picking to actually make money rather than the broader market actually easily making money for the investors.
45 days ago, nothing was going right. Tariff, FI selling, what was happening on the geopolitical front. There were concerns on rupee. But today, in end of May or beginning of June, everything is going right. Geopolitical concerns have faded away. Tariff will get implemented, but a much more diluted version. Rupee is stable. Forex reserve are back. Monsoon, it rained early this year. So are we nearing that patch, what is called as that we are the peak of good news now? And when peak of good news is there, then prices are not good?
No, I think what has happened, particularly in FY 2025, has been a slowdown in economy in general. Plus, as you rightly said, there were enough and more triggers externally also, which sort of caused uncertainty, and that sort of you had a bout of FI selling also as dollar appreciated, run up to the tariffs announcement. I think those things are unwinding, and to that extent, to look forward to, I think we will have a far stable environment to do stock picking. But when it comes down to earnings growth rate, it's not that straightforward, right? We continue to see pressures from say exports from China continues to be relentless, and segments of the market like chemicals, metals, they remain under pressure for that matter. So it as I said, it will remain bottom up while the environment becomes a little more stable than what it was for last 2-3 months. But nevertheless, stock picking will be the key.
All right. Hi, Anand. Good morning. This is Shrishti also joining in. But Anand, give us the biggest key takeaway for you from the earnings season so far, because there too, there were not much hopes, not much expectations rather, but it wasn't that disappointing for the street. So help us understand that what were your biggest key takeaway, any sector that stood out for you, and how are you penciling in FY26 growth?
I think indeed, more important this season had been the guidance. I think particularly IT sector, many capital-intensive businesses saw the slowdown, and we were looking forward to what's their commentary on outlook for FY26. And we were pleasantly surprised that the expectations, compared to the expectations where they were, I think people have come with a little bit of an upbeat commentary. Rightly so, given the corporate India is fairly deleveraged. So obviously there is, if any, opportunity to do capacity expansion and capex, it would be done given that they have balance sheet to support. Similarly, the banks are sitting on one of the lowest NPAs, and they are also geared to provide the debt capital as and when required to the private sector capex. So, yeah, I think more so the earnings were still muted. The commentaries and the outlook for the FY26 has been better than what we would have expected from the corporate India.
But Anand, what's making you bullish on the metal pack? Because in your allocation, believe that metal as a space, you hold quite a chunk there. The weightage is quite much, and you are bullish. But given the fact that even for today, as a case, when we have numbers coming in from sale, the market reaction is quite muted. When we talk to NMDC management, they are highlighting that they might not be able to hold on to that stellar margin reported in Q4. So give us your sense on the metal pack. Why do you believe that it's time for metals to shine bright?
Yeah, so it's a contrarian bet that we have taken. Look, we had very, very strong earnings in 2021, 2022, and since then, last 2 years have been very soft. We had a slowdown in China, and to that extent, and there was no slowdown in the production of metals in China, it's just a slowdown in consumption. So they have been relentless in terms of exports, especially in steel sector. They have been now tracking almost 100 million tons of annualized exports from China. Our belief is that if I see globally, uh, most of the steel companies are reeling under tremendous pressure from, and including the steel companies in China, are really struggling to make money. While Indian companies, by virtue of the captive market and iron ore backward integration, are still making reasonably good money. Our take is looking forward, and we also got the safeguard duty, which would also boost earnings and the margins in coming year. But I think even globally, given the low profitability of the sector, I expect there will be some recovery in as it is in the metals sector, and then safeguard duty, particularly in steel, that's come through, should further boost the profitability.
Is that comeback trade in metal banks over? Liquidity is now there. Stocks have run up. Do you think banks, after outperforming, could start now moving in line with markets or even underperform?
Yeah, I think when we discuss banks, I think the only thing that comes up is obviously the interest rate cuts would be a short-term negative for the banks. But otherwise, banks remain the structural play in India. I think private sector banks within the entire banking basket will continue to gain some market share. Uh, it will be slow sometimes, it will be rapid at other times, but nevertheless, as a basket, we believe the large banks have an edge in terms of the size, scale, and their ability to invest in technology. I think they will nibble into the market share and to that extent grow a little faster than the banking industry.
PSU banks cheap because the price to book for a private to PSU, now I look at SBI, BOB, all of them are looking attractive now. Is there a trade in PSU banks? Bond yields are also down.
To be very honest, we have seen one round of re-rating in last 4 years, and that's been a significant re-rating. The banks have done extremely well. They have really clamped down on NPAs. They have had a very strong recoveries. So no doubt in my mind that the fundamental performance of the banks has significantly improved, and it would be at a high in terms of new normals will be much higher than what it used to be in the past. And I think there is an opportunity to do bottom-up stock picking even within the state-owned banks. I have no doubt in it.
All right, Anand, along with that, help us with your take on the defense pack as well. Believe that you are underweight there while the whole street is talking about the kind of growth opportunities that all these defense counters offer. Defense sector as a whole is seems to be the flavor of the market. But share your thoughts. Do you believe that much of it is already in the price?
So I think we generally remain optimistic in manufacturing. To be very honest, 2010 to 2020 had been in a way a lost decade for us. when there was a relentless imports of Chinese, every manufactured goods we can think of, from safety pin to boilers, from tires to tiles, would get imported into the country, and that was a very tough period for manufacturing sector in general. And we have seen turnaround there. So we generally remain optimistic on the manufacturing, and defense is one of the large area. Apart from, as I said, metals is one large space. Space would remain another place. Railways is where we are seeing opportunities, where India is doing a lot of capex, and the government will be spending, and that would create manufacturing opportunity. So I think it all boils down to valuations, which areas, because manufacturing is a wide area. We have from textiles to metals to auto inks, to chemicals. We can actually pick and choose which area of manufacturing you want to be in, because we remain fairly confident that with the focus that we have in manufacturing now than what we had before, I think the prospects are right for the companies who can be competitive globally. And defense is just one of the many ideas that are available.
Anand, so where do you think the growth mismatch is obvious, where valuations are stacked up and earnings will disappoint? I mean, there are a lot of sectors where earnings are not coming, consumers. Earnings are just not coming. A lot of, for example, capex stocks also, earnings are not coming. Cement earnings are not coming. Where are these mismatches in the market?
So I think one of the very key criteria that we use when we invest into any sector or companies has been the consolidation versus fragmentation. And what is happening, particularly if you look at paints, we are clearly seeing fragmentation, and that's very bad news for the sector in general and companies within those sector, because there would be a price competition, there will be volume degrowth for the incumbents, and the margin degrowth also. Same thing is happening generally across the consumer segment, where new D2C brands are coming through. Also, the emergence of quick commerce and the e-commerce and the modern trade, which also means that part of the profitability will shift from the consumer businesses to the retailers. So in general, we believe consumers can have a long patch of underperformance slash derating that can happen. On the contrary, if you see a telecom as a sector, which is consolidated fairly well in last 4 years, 5 years, and it's further consolidating. So that's where we are seeing actually the earnings outperform. So I think the key to watch is where is consolidation happening versus fragmentation of the sector.
Right. Okay, Anand, great to have you on the show. Thanks for your time as always. Let me just quickly revisit where the markets also are settling in at. And
if you like this video, then like, share and subscribe to ET Now.